I'm Joe Blasick, President of Blasick Insurance Services located here in Central Ohio. I'd like to take a minute today to talk to you about group medical insurance, as it's been the center of a lot of controversy and confusion in the Ohio marketplace due to the inception mainly of the Affordable Care Act, or Obamacare as many people call it. Now, as you know, the Affordable Care Act has made many changes to group health insurance policies over the last year, and as a result, most employers are seeing drastic increases in their premium. Now, in the past, to offset these premium increases, employers have done a couple different things. Number one, they may have just switched their plan to a higher deductible option, say an HSA, to drop the overall premium cost of the plan. Or, secondly, they may have simply just moved to another carrier that offered a lower price. Now, with the Affordable Care Act stipulations like capping the maximum out-of-pocket exposures for members, implementing community rating into Ohio, and also incorporating many premium taxes and fees into these rates, these are no longer viable solutions to offset the premiums. That's the bad news. The good news is most employers don't realize that there are actually about 7 different ways that you can offer group medical insurance to your employees, all while maintaining high levels of coverage, low overall cost, and solid networks. My agency actually specializes in looking into these different methods for each and every one of our clients. Let's take a look at the different methods and how they work.
The first method of offering health insurance is fully insured. This is the most common method used for small to medium-sized groups and has the lowest amount of overall risk for an employer due to its structure. Basically, you pick a plan, pay the premium, and the carrier takes care of the administration of the plan, offers their network, and will pay for the claims other than the deductible, co-insurance, and applicable co-pays that the employees have. Pretty straightforward. On a side note, the fully insured method of funding is subject to most of the Obamacare taxes and fees, including a 2.5% insurance premium tax. This 2.5% can equate to some major dollars in larger groups. The second method is self-funding. This method is typically used for larger groups of 150 employees or more due to the high risk the employer takes on. The name of this method says it all when it comes to structure. Essentially, the employer hires a third-party administrator, or TPA, to set up the plan design, acquire very high deductible insurance called stop-loss, set up a network of providers, install a PBM, or pharmacy benefits manager for prescriptions, and to administer the claims when they come in. The costs for the TPA and stop-loss are very minimal. The risk for the employer comes with the claims, as they pay all of them other than the deductibles, co-insurance, and co-pays that employees pay for, and the balance of the claims that go over the stop-loss insurance threshold. When very few claims come in for a month, the employer makes out, but when there are a lot of major claims, this can be very financially risky. This method is subject to a couple of the Obamacare fees, but is not subject to the 2.5% premium tax. The third method is level funding. It's a cross between fully insured and self-funded. To keep it simple, this is a self-funded plan where instead of the employer paying the claims each month, which can vary greatly, carrier underwriters will estimate what they expect the claims to be for that group that year and will break this number down into monthly payments for the employees. So, instead of having the peaks and valleys of paying claims each month, the employer will have set monthly premiums as they do in a normal, fully insured model. This consistency in premiums allows us to offer these plans to smaller groups of 10 or more. On top of these benefits, if the group runs well, there's a chance to get some of their premium back at the end of the year, which is unheard of in this industry. As if this wasn't enough, since the group is technically self-funded, the 2.5% premiums tax does not apply. This is by far my favorite method of funding because of all the perks. The fourth method of funding is captive funding, and is fairly new in the insurance marketplace. It is essentially self-funding your group alongside other self-funded groups in the same insurance pool. With being part of a captive, you may have access to better stop-loss rates, and you typically pay into what they call a reserve pool along with the other captive members, so that your overall risk for very high claims is minimized. These are not for everyone, but can be very effective for certain companies. The fifth method is combining a fully insured plan with a health reimbursement account, or an HRA. The best way to describe this method is by giving an example. In this example, company ABC currently offers a $1,000 deductible to their employees, but they can't afford the premium for it anymore. They purchase a $2,000 deductible plan instead, which costs less, and agree to pay the second half of the deductible, or $1,000, should the employees use this much of their benefit. To the employee, the deductible remains at $1,000, and to the employer, they are paying less premium to offer the same plan to their employees. They are now just taking on some potential risk on the back end of the deductible. The sixth method is combining a fully insured plan with a premium saver plan. This method acts exactly like the previous HRA example, except instead of the employer taking on the potential risk for the back end of the deductible, they would purchase a small insurance plan called Premium Saver to cover these potential costs. The premium for this type of plan are very, very minimal. The seventh and final method is implementing a fully insured plan with a defined contribution. Instead of the employer saying that they will pay 50 or 75% of the premium for each employee, they'll agree to pay a set dollar amount for a lean plan, we call this the base plan, and then we'll offer a rich option or a buy-up plan to the employees. This lets the employer name their price on health insurance premiums for the year and also gives the employee the opportunity to pay a small amount for a leaner plan or pay a bit more to have better coverage.
So there you have it, 7 different ways to offer health insurance to your employees. Thanks so much for taking the time to go through this with me today. Hopefully it was beneficial for you. Have a great day, and as always, go Bucks.